And Thomas Hayes, the chairman and managing member at Great Hill Capital, joins us this morning for more. Thomas, let's talk about stocks in sell-off mode following Fitch's downgrade. Could it get worse for U.S. equities, and how long could this volatility last?
Well, Liz, great to be with you. As you said, down 1.4%. But you have to put in perspective that's after being up 31% off of the October lows, a rally that many people missed. And what we find with these type of moves that are catalyst driven with the downgrade is that the first move is often the wrong move, because if we look back to 2011, the last time the debt was downgraded at that point by S&P, the initial move is yield spike. But as you look out, actually, the bonds start to get bid. And in the 12 months following the downgrade in 2011, the 10-year note yield went from 3.5% down to 1.39. So that initial knee-jerk to 4.07 may in fact be the wrong move. And the move looking forward may be that people realize if the U.S. got downgraded, then what's coming next, which is what we saw last time. Are there going to be European downgrades? And if there are going to be European downgrades, then the U.S. Treasury, the U.S. dollar as the world reserve currency, is going to look the safest, and you're going to see a compression of yields and massive demand for U.S. Treasuries just in time for the Treasury to issue $1 trillion of bonds over the next few weeks.
Yes, speaking of that, the Treasury's new borrowing plans to increase the bond sale size in order to cover that deficit. What is the impact likely to be on yields? What does this mean for markets and investors?
Well, I think prior to yesterday, when Fitch downgraded the credit rating, it was a little bit interesting to see what would happen with $1 trillion of supply on the market. But I think as we saw in 2011, as people start to think about other knock-on effects, if you recall, it led to a multitude of downgrades in Europe, and Mario Draghi had to come in with his bazooka and say, we'll do whatever it takes. And I think as yields are over 4%, that seems to be the area where it starts to cause trouble and where central banks start to step in. You saw it with the pound over a year ago and different instances where the Fed, where different central banks had to add liquidity. So I think in coming weeks, you're actually going to see, after this initial knee-jerk reaction, some level of demand, which could push down yields and facilitate a more easy issuance of U.S. Treasuries. As far as the stock market, you've seen many institutions, if you look at institutional positioning coming into this, the stock market was red hot, but institutions were dramatically underweight, taking risk levels at their lowest levels since the great financial crisis lows in March of 2009 and the COVID lows. So a lot of them missed this rally. So we think that on normal 3 to 5% seasonal pullbacks, we're moving into a seasonally weak period. August and September is historically weak. They're going to be met by bids from institutions trying to play catch up to their benchmarks.
And what is your overall assessment of the U.S. economy, and how have the latest developments impacted that, if at all?
Well, I think it's going to be less than people expect. If you look at the Atlanta Fed, they put out their GDP now number, estimating Q3 GDP at plus 3.9%. I think very few people were looking for a plus number just a couple of months ago. Also, we're in the middle of earnings season, and earnings are actually coming in somewhat better than expected. We're looking at estimates and guidance have been taken up to $246 for the S&P for 2024. So that was surprising to a lot of people. So earnings are holding in there. GDP is coming in better than expected. We had a hot ADP number. We'll see what the jobs number looks like. And inflation continues to come down. So the Goldilocks scenario was there. We'll see the knock-on effects of this Fitch downgrade, but Fitch is a third-tier rating agency, so it may not be as impactful as S&P was in 2011. But we do have to keep an eye on, does it lead to other downgrades in Europe? And if so, I think the global central bankers are going to be back in action, providing liquidity before we know it.
Well, many thanks for your insights this morning. Thomas Hayes there from Great Hill Capital.